Hello everyone, thank you for tuning in. I made my very first sale of a dividend stock. I completely sold my Kellogg's position. Founded in 1906 in Battle Creek, Michigan, Kellogg's has been a staple in a lot of households. It is a plant-based company with tons of recognizable brands that covers breakfast, snacks, and dinner. Some of their brands are Special K, Pringles, Cheez-It, Corn Pops, and Cook Mito, and the list goes on. Looking at the max chart, the stock is up a little over 2,000%, and they have been paying dividends since 1925. This is before the company was publicly traded in 1952. So why did I sell Kellogg's? Let's start with dividend. The yield is 3.43% with a decent payout of 55.40%. So the company has room to increase the dividend. They have continuously increased it for the last 17 years straight. Now, looking at the 5-year growth rate, it's sitting at 2.41%. This is hovering over the average inflation. This is too low for me, and I will need something of at least 5% or higher consistently. The next reason will be the revenue growth. The revenue year over year is a little under 3%, and the growth of the revenue is 1.54%. This is very, very low. Also, the levered free cash flow is negative 30%. This is slowly eating the free cash from the company. The company is profitable, but with the money coming in, it doesn't look appealing to earn a spot on my portfolio. The other reason is the investment Kellogg's made into Morningstar Farms. It's a plant-based food company, competition of Beyond Meat. This was acquired by Kellogg's in 1999, and Kellogg's made a $43 million investment to expand the company. The plant-based market is expected to double the value of 2020 from $4.3 billion to $8.3 billion by 2025. This is a 14% annual growth in terms of value. When we analyze Morningstar Farms, we see a different story. Even though it has some strengths like having a strong market share and a revenue per employee greater than the industry, I want to take a look at the very last weakness. Since it was founded, it's experiencing slower revenue growth. Just looking at the annual revenue quarter per quarter, it has dropped dramatically. From quarter 4 of 2018 to quarter 2 of 2021, it is down 36%. In USD, this is from 8.6 million to 5.45 million. I don't think that the up-to-date numbers have changed in a positive tone. So in conclusion, I don't think Kellogg's is a bad company to own. It's a good dividend stock for those looking for income while being retired, but for me, it was not looking like the best fit in my portfolio due to slow growth. The position with Kellogg's was started in September 2020 and sold for a small profit of $35.07. This is counting dividends. This gives me around an extra $350 of buying power to buy Starbucks and AT&T. AT&T successfully closed the deal for the spin-off of selling Warner Media to Discovery. This allows AT&T to fully focus on the core business of the company and be more strategic in paying down debt. As a young investor with more than 20 years left of investing, this could be a growth opportunity to my current AT&T holding. Even with the dividend reduction, AT&T has a high yield and an extremely good free cash flow to increase the dividends in the upcoming years. I have not purchased any AT&T yet. I am waiting for the WBD shares and the price adjustment so I can proceed and add more. Then we have Starbucks, a company that has suffered from government regulations, supply chain issues, and the latest news, the cancellation of the stock buybacks. All of this has sent the stock value to go down by 30%. A lot of investors see the buyback cancellation as a negative move since it reduces the value appreciation for investors, but in my honest opinion, this is the best move to battle unions. The money for the buyback will be used to invest in the stores and employees. So long term, Starbucks will continue to expand regardless of any buybacks or not. The stock price will follow the fundamentals of the company. Moving forward to my portfolio where I invest $100 every week, I made a little update to the charts. In previous videos, I used to show the amount of shares that I had in every company. Now, I will display the amount of dividends paid yearly per position. I believe it's more relevant showing the yearly amount than just the shares that I own. Okay, let's continue. Portfolio value sitting at $5,575.73 with a dividend yield of 3.40%, which translates to $181.27 in yearly dividends. currently have 15 holdings. Portfolio value didn't move when compared to the previous video, and this is because I only count the value in shares for the portfolio updates. I do not count buying power. Yearly dividends and holdings went down for selling Kellogg's, and I expect the yearly dividend to go further down when we reach the ex-dividend date for AT&T. This week I bought 3M and Starbucks. Went a little heavy on Starbucks, almost hitting a 10% allocation. But as mentioned before, I believe it is a great long-term hold and will continue to add more at the current prices. The same with 3M. It will be an interesting week when I receive the WBD shares, as I'm planning to sell them and start buying AT&T again. So that will be it for today's video. Make sure to like, subscribe, and I'll see you on the next one.